It's Wednesday morning, January 21st, 2026. I'm sitting here watching two completely different prices for the exact same metal being quoted on opposite sides of the planet. And I need you to understand why this is the most important development in precious metals markets since 1980. I'm a private commodities analyst. I've spent 12 years tracking physical silver flows, vault inventories, and the mechanisms that most retail investors never see. I built this channel using an AI avatar for one reason: speed. Because when you're watching a market fracture in real time, you can't afford to wait for some mainstream outlet to figure out what's happening. And frankly, I'm tired of watching other channels pump out recycled headlines when there's actual data that explains why your screen is showing you a fiction. Here's what they're not telling you. Right now, at this moment, physical silver in Shanghai is trading at $103 per ounce. Pull up your phone and check the spot price. It says $95.78. That's a $7 gap. Earlier this week, that gap hit $13. On January 14th, unconfirmed reports from Tokyo showed physical bars trading at $130, while COMEX paper silver quoted 91.73. That's a $38 premium. A 41% gap between what the screen says silver is worth and what people are actually paying to hold it in their hands. This isn't a glitch. This isn't a temporary dislocation. This is a structural fracture in the global silver market. And the mechanism driving it is something the financial media refuses to explain, because doing so would expose just how fragile the entire pricing system really is. Let me be very clear about what I'm claiming here, because this is not speculation. On January 1st, 2026, China implemented export licensing requirements that effectively removed 60 to 70% of globally traded refined silver from international markets. That's not a quota reduction. That's a categorical reclassification of silver from a tradable commodity to a strategic material requiring government approval for each shipment. Only 44 companies received licenses to export silver for the entire 2026-2027 period, down from hundreds of refiners who previously had open access to global markets. At the same time, COMEX registered inventories have collapsed to 127 million ounces, down from 346 million ounces in 2020. That's a 63% decline. The daily delivery demands are spiking to 8 million ounces or more, and the March 2026 open interest represents 725 million ounces of potential delivery demand against 127 million ounces of available supply. That's a leverage ratio of 5.9 to 1. In a normal market, you see 2 to 1 or 3 to 1. We are in territory that has never been tested in modern COMEX history. Here's my primary claim, and I'm going to prove it to you with hard data, math, and a mechanism that most investors don't understand exists. The Shanghai premium is not a market anomaly, it's a warning siren. It's telling you that the arbitrage bridge connecting Eastern and Western silver markets has collapsed. Physical metal cannot flow freely between markets anymore, which means price discovery is fragmenting into regional silos. And when that fragmentation reaches critical mass, when delivery obligations exceed available inventory, we're looking at a potential force majeure event. A formal declaration that the exchanges cannot fulfill their contractual obligations to deliver physical metal. If you think that sounds extreme, you haven't been paying attention to what happened with nickel in March 2022. And I'm going to show you exactly why that precedent makes everything I am describing not just possible, but increasingly probable. Let me give you the snapshot from this afternoon, because the numbers tell a story the headlines are hiding. Silver spot price, $95.78. That's a new all-time high. Shanghai silver price, $103 per ounce. Premium $7.22. That's a 7.5% arbitrage gap that should not exist for more than a few hours in a functioning market. Earlier this month, on January 13th, Shanghai printed $105, while COMEX showed $92, a $13 premium, 14.1% gap. Now let me teach you why this gap matters so much, because this is the mechanism that explains everything. In a normal commodity market, arbitrage traders ensure price convergence across global exchanges. The process works like this. If silver is trading at $90 in New York and $100 in Shanghai, an arbitrage trader will buy silver in New York, ship it to Shanghai, and sell it for a $10 profit. Minus transportation costs, insurance, maybe $1 or $2. That constant flow of metal from low price zones to high price zones is what keeps global markets synchronized. It's what makes the spot price meaningful. It's what allows a price in London to represent the same value as a price in New York or Shanghai. When that arbitrage mechanism breaks down, you get exactly what we're seeing now. Two separate prices for the exact same metal. A premium market in Asia where buyers are desperate for physical supply, and a discounted market in the West where paper contracts trade freely, but physical metal is increasingly unavailable. Think of it like two swimming pools connected by a pipe. When the pipe is open, water levels equalize. If one pool is higher, water flows until they match. Now imagine someone puts a valve on that pipe that only opens occasionally and unpredictably. The pool levels start to diverge. One gets deeper while the other gets shallower. That's what China's export controls have done to the global silver market. They've put a valve on the flow that used to keep prices synchronized. Here's why the arbitrage bridge collapsed and why it's not coming back anytime soon. Physical constraints first. China's January 1st export licensing requires government approval for each shipment, not a blanket quota you can fill at your discretion. Individual approval for each transaction that creates unpredictable delays and outright denials. Shipping silver from London to Shanghai takes 4 to 6 weeks. During that time, price volatility can eliminate your profit margin entirely. Shanghai futures exchange warehouses are at decade-low inventory levels, so even if you can ship the metal, there's no guarantee you can deliver it into the system. Financial constraints next. Borrowing silver to execute arbitrage now costs 8% annualized. The historical norm is 0.5 to 2%. At 8% lease rates, your carrying cost eats your profit margin before you even ship the metal. COMEX increased initial margin requirements by 25 to 40% in late 2025 due to volatility. That means you need more capital to execute the same trade. And counterparty risk is spiking because everyone is worried about delivery failures, regulatory barriers on top of all that. The United States designated silver a critical mineral in November 2025, potentially restricting exports. China's foreign exchange controls limit the ability to repatriate profits from arbitrage trades, and Trump's threatened tariffs on multiple countries create additional pricing uncertainty. The result is an arbitrage gap that should close in days has now persisted for weeks, widening at times despite every economic incentive to exploit it. That's not normal market behavior. That's market fragmentation. That's the definition of a structural break. Now let me show you what's happening on the supply side because the vault data tells a terrifying story. COMEX operates on a two-tier inventory system. Registered silver is available for delivery against futures contracts. Eligible silver meets quality standards but is privately owned and not available for delivery. Right now, registered silver sits at 127 million ounces, down from 346 million ounces in 2020. That's a 63% collapse in deliverable inventory over 6 years. Here's the math that doesn't work. March 2026 open interest represents 145,000 contracts at 5,000 ounces each. That's 725 million ounces of potential delivery demand. Registered inventory is 127 million ounces. The leverage ratio is 5.9 to 1. Normal leverage is 2 to 3 to 1. Stress threshold begins at 4 to 1. We are well beyond stress threshold into unprecedented territory. On January 7th, 8.1 million ounces were delivered against contracts. JP Morgan issued 99% of those delivery warrants. Normal January deliveries are 2 to 4 million ounces because January is an inactive delivery month. We're seeing 200 to 400% above historical baseline in what should be a quiet month. If 20% of March open interest stands for delivery, that's 145 million ounces of demand against 127 million ounces of supply, an 18 million ounce shortfall. And that's a conservative estimate. In stressed markets, delivery percentages can spike to 25 or 30%. COMEX has 3 options if delivery demand exceeds supply. Convert eligible to registered by convincing private owners to sell. But why would they sell at current prices when premiums are rising? Source from the spot market by buying in London and shipping to New York. But London is also depleting, and transportation takes weeks. Cash settlement by paying contract holders cash instead of physical metal. But that destroys confidence in futures as a price discovery mechanism. London is experiencing the same drain. LBMA vault holdings dropped from 827.5 million ounces in Q4 2024 to 711.4 million ounces by March 2025. That's 116 million ounces gone in 1 quarter. A 14% decline, that's equivalent to Peru's entire annual silver mine production, vanishing from London vaults in 90 days. Where did it go? ETF redemptions, industrial delivery to manufacturers, shipped to Asia, possibly central bank accumulation in emerging markets. The LBMA only publishes vault data monthly, creating transparency gaps that fuel uncertainty. Their CEO, Ruth Crowell, acknowledged they're considering weekly publication of silver inventory levels because they recognize transparency is critical to maintaining confidence. But implementation is slow. Here's the paradox that should terrify anyone holding paper silver. BlackRock's SLV ETF saw 16 million ounces withdrawn in January alone despite silver prices rising 30%. That's backwards. When prices rally, ETF holdings should increase as investors chase momentum. Outflows during a 30% rally are highly abnormal. It means large institutional holders are redeeming shares and taking physical delivery rather than continuing to hold paper claims. They're voting with their feet. They're saying they don't trust the paper anymore. The U.S. Mint suspended silver sales on January 13th. citing inability to source blanks from refiners at any price. The mint doesn't buy silver in the spot market. They have long-term contracts with domestic refiners. If refiners are telling the mint they cannot supply blanks at any price, it means every ounce is spoken for. Industrial buyers paying premiums have priority. Refining capacity is maxed out. There's not enough raw silver available to refine. APMEX, the largest retail dealer in the United States, instituted $500 minimum orders on January 19th. They're rationing access. SD Bullion and JM Bullion report 2 to 6 week delivery delays. Premiums over spot are running $6 to $12 per ounce for Silver Eagles versus the historical norm of $2 to $3. The retail market is telling you the same story as the Shanghai premium. Physical silver is scarce and getting scarcer. Now let me teach you about lease rates, because this is the smoking gun that confirms everything I've been describing. Silver lease rates represent the annualized cost of borrowing silver in the London spot market. They function like interest rates, but for physical metal instead of currency. Normal rates run 0.5 to 2%. That indicates abundant supply and easy borrowing. Rates of 5 to 8% signal physical shortage, with lenders demanding premium. Rates above 8% indicate crisis conditions with severe shortage. Right now, silver lease rates are at 8%. In October 2025, they briefly spiked to 34.9% during an LBMA delivery squeeze before subsiding. The current 8% rate has persisted for over 2 weeks. It has not returned to normal levels. What does an 8% lease rate tell you? Borrowers are paying 8% annually to access physical silver for short-term use. That's only economically rational if the borrower expects silver prices to rise more than 8% before they return the metal, or if the borrower desperately needs silver for production and has no alternatives, or if the borrower is executing arbitrage between London and Shanghai where the premium exceeds the lease cost. Previous lease rate spikes were short-lived. The 2008 Lehman collapse spiked rates to 12% for 3 days. COVID lockdowns in March 2020 hit 7% for 1 week. The 2011 retail frenzy at the $49 peak hit 5% for 2 weeks. All of those spikes resolved quickly because the catalyst was temporary. This spike is different. It's persisting because the causes are structural, not temporary. China's export controls are policy, not a market event. The 5-year deficit has depleted above ground stocks. Industrial demand is locked in and cannot be deferred. Citibank's January 2026 silver report identified lease rates as the critical metric for determining when the physical shortage resolves. Their framework says the bull case remains intact while lease rates stay above 5%, while COMEX inventory continues declining, while Shanghai premium persists above $5. All three conditions are flashing green right now. Let me address China specifically because their export controls are the catalyst that broke the market. China accounts for 60 to 70% of globally traded refined silver. They're not a major miner. Most ore comes from Mexico, Peru, and Chile. But the ore has to be refined and most of it gets processed in China. Their monthly export volumes surged to 660 tons in October 2025, a record high, as Traders Front ran the anticipated controls. Then, on January 1st, the valve shut. The licensing criteria eliminated most small and mid-sized Chinese silver refiners from the export market. Only the largest state-connected enterprises receive permits. That creates effective government control over all silver leaving China. The 44 authorized companies must meet an 80-ton minimum annual production capacity requirement, elevated capital requirements, and government review of each shipment destination and end use. Permits are revocable with no appeals process. Why would China do this? 3 strategic objectives. First, secure domestic supply for industrial policy. China manufactures over 80% of global solar panels. Securing silver ensures production continuity. Chinese EV makers like BYD, NIO, and XPeng require reliable silver supply for electrical systems. Consumer electronics, semiconductors, 5G infrastructure all require silver. Second, geopolitical leverage. The controls create supply pressure on Western manufacturers dependent on Chinese silver. They create pricing power through the ability to influence global prices by withholding or releasing supply. Silver export permits can be conditioned on technology transfer or market access concessions. Third, economic nationalism. Rather than exporting refined silver, China prefers exporting finished goods like solar panels and EVs that incorporate silver and capture more value. It aligns with broader Chinese policy of treating natural resources as state assets. The math of the supply shock is straightforward. Global refined silver supply is approximately 1 billion ounces annually from mine production plus recycling. China's refined exports were around 121 million ounces in 2024. Assuming a 50 to 75% volume decline from the export restrictions, you're looking at 60 to 90 million ounces removed from global trade. The pre-control deficit for 2025 was 95 to 117 million ounces. The post-control deficit for 2026 is projected at 200 million ounces or more. The cumulative deficit from 2021 through 2025 is 820 million ounces. That's equivalent to Mexico's entire 4-year production. Add 2026, you're looking at over 1 billion ounces of cumulative deficit since the structural shortage began. Now let me tell you about India, because they provide a parallel data point confirming Asia's physical shortage. India imported $9.2 billion of silver in 2025. That's a 44% increase from 2024, is $6.4 billion. January 2025 alone saw 875 tons imported, the highest monthly volume since 2008. India now accounts for 21.4% of global refined silver imports, making them the world's largest importer of the metal. Indian premiums over London spot were running 3 to 5% in December 2025. By January 2026, they've expanded to 10 to 17% depending on region and product. The Mumbai benchmark is trading at the equivalent of $95 per ounce versus $91.50 in London. Unlike China, India has no export restrictions. The premium reflects genuine demand versus supply imbalance. Industrial demand for electronics, solar, and EVs is consuming record volumes. Investment demand through ETF inflows hit 17.59 billion rupees in July and 19.04 billion rupees in August, triple the prior year's monthly average. Wedding season and festivals maintain baseline jewelry and silverware demand. And India produces almost no silver domestically. They're 95% or more dependent on imports. The Global Trade Research Initiative warned that India's heavy import dependence represents a strategic vulnerability. China controls 70% of refined silver processing. Silver is critical for India's solar energy transition, with a government target of 500 gigawatts by 2030. And India has no long-term supply agreements with major producers. Now I need to tell you about force majeure, because there's a legal precedent that makes everything I am describing not just theoretically possible, but practically executable. Force majeure is a contractual clause that excuses parties from performance obligations due to extraordinary events beyond their control. In commodities markets, it typically refers to natural disasters, war, government actions, or market conditions that make performance impossible. That last category is controversial, but it has legal precedent. On March 8, 2022, the London Metal Exchange faced an existential crisis. Nickel prices quadrupled in 3 days, threatening to exhaust the clearinghouse default fund and put multiple members into bankruptcy. Chinese producer Tsingshan Holding Group had massive short positions estimated at 200,000 tons worth over $8 billion. As prices spiked due to Russia-Ukraine war supply fears, Tsingshan faced catastrophic margin calls it couldn't meet. The entire clearinghouse faced contagion risk. The LME suspended nickel trading and announced cancellation of all trades from 1 a.m. onward. 8 hours of executed trades simply voided. Thousands of contracts representing billions in notional value deleted from existence. Market participants who profited from the price spike sued the LME, arguing that canceling trades exceeded the exchange's authority, violated property rights, and that market disorder was too vague a justification. In November 2023, the UK High Court ruled in favor of the LME on all grounds. The ruling stated that the LME's rulebook grants authority to cancel trades during market disorder. That market disorder includes situations threatening clearinghouse solvency, that protecting systemic stability outweighs individual profit expectations, and that the decision was within the exchange's discretion. Stop and absorb what that means. A major commodity exchange can retroactively cancel executed trades, suspend trading indefinitely, prioritize systemic stability over contract sanctity, and define market disorder with broad discretion. There is now legal precedent for voiding contracts during commodity squeezes. The parallels between LME nickel in March 2022 and COMEX silver in January 2026 are striking. Both involve massive price spikes. Nickel moved 111% in 9 hours. Silver has moved 150% in 12 months, with 30% in the last 30 days. Both involve concentrated short positions. Tsingshan had a 200,000 ton short. Commercial banks currently have 232,000 contracts short on COMEX. Both involve physical shortages. Nickel faced Russian supply cuts from the Ukraine war. Silver faces China export controls and a 5-year structural deficit. Both create margin stress and systemic risk. What would trigger silver force majeure? 3 scenarios. Scenario 1, March 2026, delivery failure. First notice day is February 20th. If 20% or more of 145,000 contracts stand for delivery, that's 145 million ounces of demand. Registered supply is 127 million ounces. The shortfall cannot be covered. Scenario 2, mass cash settlement refusal. COMEX offers cash instead of physical metal. Contract holders refuse, demanding delivery. The clearinghouse faces legal liability exceeding reserves. Emergency suspension follows. Scenario 3, custodian failure. JP Morgan is the dominant COMEX warehouse operator. If JP Morgan declares inability to source metal, the warehouse defaults on delivery obligations. COMEX invokes force majeure due to custodian failure beyond exchange control. The legal justification post-LME precedent is clear. Market disorder evidenced by 5.9 to 1 leverage, $10 Shanghai premium, 8% lease rates. Systemic stability requiring prevention of clearinghouse default. Impossible performance due to physical metal unavailable because of China export controls, which constitute government action. What happens after force majeure? Based on the LME precedent, immediate actions would include trading suspension on all COMEX silver futures, contract cancellation of some or all recent trades, forced cash settlement at a determined reference price, and new position limits to prevent concentration. Medium-term consequences include COMEX losing credibility as the silver pricing benchmark, spot market decoupling completely from futures, Shanghai and Mumbai becoming dominant price setters, and regulatory intervention through CFTC emergency orders. If force majeure is declared, paper silver and physical silver become two completely separate assets with two completely separate prices. Physical holders would see massive premiums. Futures longs would be forced into cash settlement at potentially unfavorable prices. Mining stocks would benefit from higher sustained prices. ETFs would face redemption crises if unable to source metal. Industrial users would face supply chain disruptions. Now let me steelman the counter-argument because I want to address the strongest case against this thesis. Skeptic argument number 1. The Shanghai premium is a localized liquidity spike. It's temporary, caused by Chinese New Year demand or some regulatory quirk. It will normalize. Here's my rebuttal. The premium has persisted for 3 weeks now. In a normal market, a $10 arbitrage opportunity attracts billions in capital within hours. Traders would buy in New York at 90 and sell in Shanghai at 100, pocketing the spread. The fact that this hasn't happened, the fact that the premium persists despite every economic incentive to close it, tells you the arbitrage bridge is physically broken. The metal cannot flow. This isn't temporary. China's export controls are policy, not a market event. They're not going away. Skeptic argument number 2. High prices will destroy demand. At $95, industrial users will substitute cheaper materials. Solar manufacturers will switch to copper or aluminum contacts. The price will crash once demand destruction kicks in. Here's my rebuttal. Industrial substitution takes years, not days. If you're a solar panel manufacturer and your entire production line is built around silver paste for the conductive layer, you cannot flip a switch and start using alternatives. You have to re-engineer the product, retool the factory, run quality tests, get new certifications. That process takes 18 months minimum. Chinese manufacturer LONGi announced base metal solar cell backs in development, but mass production is mid-2026 at earliest. And even with 30% silver reduction per panel, total deployment growth still increases absolute demand. The substitution argument doesn't work on short timelines. Skeptic argument number 3. Paper shorting can stop this. The bullion banks will just short the futures market and crush the rally like they always do. Here's my rebuttal. In a physical arbitrage situation, a paper short is just a promise to deliver metal that may not exist. If Shanghai is paying $103 and New York paper says $95, the paper price is the fiction. The shorts can manipulate the paper price all they want. They cannot manipulate the physical flow. And the physical flow is one directional right now. It's going east. Every ounce leaving Western vaults to satisfy Asian demand is an ounce that cannot back paper contracts in New York. Let me tell you about industrial demand because this is the component that makes the shortage structural rather than cyclical. Solar photovoltaics consumed 200 million ounces of silver in 2024. That's 29% of total industrial demand, up from 11% a decade ago, a 164% increase in market share over 10 years. The average solar panel contains 15 to 25 grams of silver. Global installations hit 500 gigawatts in 2025. The IEA projects 3,200 to 4,400 gigawatts of cumulative capacity by 2030. The EU has a legally binding mandate for 700 gigawatts by 2030. The US Inflation Reduction Act subsidizes domestic solar manufacturing. This demand is locked in. Government mandates have legal force. Climate subsidies make deployment economically inevitable, regardless of material costs. Planning cycles for solar farms run 2 to 5 years, meaning silver cost is a small fraction of total project cost. Net zero deadlines for 2030, 2035, and 2050 create urgency that will not respond to price signals. Electric vehicles use 67 to 79% more silver than internal combustion engine vehicles. An ICE vehicle contains 15 to 20 grams of silver. A battery EV contains 25 to 50 grams. Applications include battery management systems, power electronics, charging ports, electrical contacts, and sensors. Global EV sales increased 21% in 2025. By 2027, EVs will overtake ICE as the primary source of automotive silver demand. By 2031, EVs will represent 59% of automotive silver consumption. AI data centers are the emerging wildcard. A large-scale AI facility can require 5,000 to 10,000 tons of silver for cooling systems, electrical distribution, backup power, and high-speed interconnects. AI workloads generate 5 to 10 times more heat than traditional computing, requiring advanced cooling with silver-soldered heat exchangers. Microsoft has announced $80 billion in data center investment for 2024 through 2026. Google is spending $50 billion. Amazon AWS is in massive expansion. These facilities will consume 10 to 30 million ounces annually by 2027. Total industrial demand for 2025 was 689 million ounces. Solar at 200 million. Electronics at 250 million. Automotive at 20 million. Brazing and soldering at 60 million. Other applications at 159 million. This demand is structurally high and relatively price inelastic. Unlike investment demand, which can reverse quickly, industrial buyers must have silver for production. They will pay higher prices before shutting down operations. Mine supply cannot respond. Production peaked at 900 million ounces in 2016 and has declined to 835 million ounces in 2025, a 7.2% decline from peak. Ore grades have dropped 30% since 2000, meaning miners must move 30% more rock to extract the same silver. 71% of silver comes as a byproduct of copper, lead, zinc, and gold mining, so silver production is enslaved to base metal economics. Permitting timelines run 5 to 10 years. No major new primary silver mines have been developed during the decade-long bear market from 2011 to 2020. The current rally is too recent to have generated new projects. Here's my personal dashboard for the next 30 days. First, I'm watching COMEX registered inventory. If it drops below 100 million ounces, the leverage ratio becomes mathematically untenable. Alert level. Second, lease rates. If they exceed 10% sustained or fall below 3% sustained, that's a signal. Above 10 indicates crisis acceleration. Below 3 indicates the shortage is resolving. Third, Shanghai premium. If it exceeds $15, force majeure risk spikes. If it compresses below $3, the thesis weakens. Fourth, March 2026 open interest as we approach first notice day on February 20th. If open interest exceeds 150,000 contracts, delivery stress is likely. Fifth, China policy announcements. Any indication of export control relaxation is the bear case trigger. Watch the Ministry of Commerce. Let me give you the probability assessment based on all the data I've presented. Base case at 60% probability. Manage crisis with no force majeure. COMEX and LBMA manage delivery stress through higher margin requirements, position limits, encouraging cash settlement, and coordinated central bank leasing. Silver trades in a range of $95 to $120 through the year, with the March delivery creating a spike toward the upper end. Bull case at 25% probability. Force majeure declared. March delivery overwhelms COMEX. Paper silver crashes to $70 or $80 as confidence breaks. Physical silver spikes to $130 to $150 on panic buying. Premium between physical and paper expands to $50 or $70 per ounce. Bear case at 10% probability. China relaxes export controls due to domestic economic weakness or trade negotiations. Supply increases 50 to 70 million ounces annually. Silver corrects to $65 to $75. Shanghai premium collapses. Lease rates normalize. Extreme case at 5% probability. Force majeure triggers contagion. London simultaneously fails. Multiple bullion banks face insolvency. Government intervention required. Silver spikes to $150 to $200. Possible government confiscation or windfall taxes. Here's my 3-sentence recap. The Shanghai premium is not noise. It is a structural fracture in the global silver market caused by China, as export controls were moving 60 to 70% of globally traded refined silver from international markets. COMEX faces a 5.9 to 1 leverage ratio, with March delivery representing 725 million ounces of potential demand against 127 million ounces of registered supply. The force majeure precedent from LME nickel in 2022 establishes legal framework for exchanges to cancel trades and suspend delivery when physical shortages threaten systemic stability. The price on your screen says $95. Shanghai says $103. Tokyo reportedly saw $130. The lease rate says 8%. The vault data says inventories are collapsing. The industrial demand data says consumption is locked in by government mandates and cannot be deferred. Every signal is pointing in the same direction. The physical silver market is in structural shortage. The paper pricing mechanism is diverging from physical reality. And March 2026 is the date when the system faces its stress test. The mainstream media is going to tell you this is temporary. They're going to call it a localized anomaly. They're going to trot out analysts who explain why $95 silver is unsustainable. And while they're doing that, central banks are accumulating, industrial users are hoarding, and the Shanghai premium is telling you exactly how much real buyers are willing to pay for metal they can actually hold. Physical silver offers asymmetric risk-reward. The downside to $65 or $70 is limited because the structural deficit persists regardless of China policy. The upside to $150 or higher is real if force majeure is declared and paper claims are invalidated. The question you have to ask yourself is whether you want to be holding paper promises or physical metal when the system hits its breaking point. Stay sharp, stay positioned, and watch March 2026.